This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. The Planet MicroCap Showcase Vegas is happening April 30 through May 2nd, 2024 at the Paris Hotel and Casino in Las Vegas. Our event brings together the best investors and thought leaders in microcap, quality microcap investing opportunities, and above all else, the most fun and highest return on your time that you could ask for. If you'd like to register to participate, please visit planetmicrocapshowcase.com. See you in Vegas. Now, my guest on the show today is ToffCap. He's a fund manager and editor of the ToffCap newsletter on Substack and is better known as @ToffCap on Twitter X. We discuss a whole host of topics derived from both his newsletter and his posts on social media, including Toff's criteria, what his investable universe looks like, what's intriguing about cannabis, as well as his investing theses on both ADF Group and DNO. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my interview with ToffCap. ToffCap, thank you for joining me today. How you doing?
Thank you, Bob, for inviting me. Again, big fan here, long-time listener to your podcast. Love it. Love what you do, and obviously the people that you invite. So very happy to be invited.
Absolutely. Thank you for joining me. And how should we do this? Because I know you want to remain anonymous. So I literally don't even know your first name, even off air. So ToffCap, Toffee. I don't know. You tell me how I should. I think just we'll go
people calling me Toff. I'll just say ToffCap. I mean, I don't care. It's unfortunate that it has to be this way. I mean, compliance is very strict, but I hate it, but it is what it is. And I'm just happy that I can be here with you.
It's such an interesting phenomenon, right? Like, because there's a few of us in the space. We're all colleagues. We're all buddies here. We do interviews with investors and stuff, and it's so interesting that within the realm of podcasting, just in this niche in finance podcasting, that you have to remain relatively anonymous. It's so interesting.
To be honest, I think it's insane because I have, for example, we will talk about that, but I'm a fund manager. I manage some funds, and over the years, it's almost now I'm going up on. I think it's almost 20 years now in the business, and I have a big network, and there are so many of my friends / peers, colleagues out there that can just do whatever they want, and others. I mean, not everybody. But, we're all basically doing the same thing. But, for some reason, compliance here and there is way more stricter and others have way more flexibility. So it's annoying. And I'm having this conversation with also friends who I know in real life on X. And every time I see them, they chuckle, on the fact that I have to remain anonymous, etc. But again, I'm happy I can do this anyways because I know people who are not allowed even. So
no, what's really cool is the fact that you're putting out so much good quality content on your Substack, the ToffCap Substack, as well as on Twitter X. That it's great that we can at least compliance gave you the thumbs up to come chat with me here today. So
yeah, sure.
So since you are anonymous, it's not, we can't really get into your personal background, get into how you came into investing and all that kind of stuff. So I figured we'd start off before we jam on a few sectors and areas of interest for you from your Substack and also your Twitter X. Get kind of your background on your investing thesis as well as your philosophy, how you assess new ideas. So let's start off there and then we'll go.
Absolutely, and I can actually say something on my background, but and I will remain, just the broad.
People are going to put the pieces. People are going to put the pieces together, dude. I hope you. Okay.
I don't think so, but let me just start. Some very broad strokes. So Coming from a big entrepreneurial family, um, that's one of the reasons why I like investing for all the possibilities. But this big family was mostly operational, not so much financial. And even so, the finance world and financial institutions were often looked down upon, considered maybe to be the bad guys. So I always had this inherent interest into the stock market and investing, but it took me quite some time to actually move towards the public markets. In the end, I decided to do something in engineering. But for my master's, I moved into finance and investments. It took quite some time because I had to go back, redo a lot of courses, etc. In the end, started in corporate finance, and I was very, very lucky. And I mean, over the course of my career, I've been very lucky many times. But I got a job in the valuations team in corporate finance, and just as the name implies, it was a lot of valuation related projects. Obviously, company valuations as well, but asset valuation, tax related audit valuations, dispute resolution, divorces even. And that ingrained into me that everything has a value. Almost everything has a value, and that value is maybe also in the eye of the beholder, so to speak. And after a few years of doing this, and lots of accounting, I thought, this actually, all this skill set, why don't I apply this to the public markets? And I went out and I actually was able to find a job as a junior portfolio manager. Again, another stroke of luck because I had no experience whatsoever managing funds. And I landed this job, and I thought I was going to be a sector or analyst, or handed me a few stocks. But it was literally, this is your colleague, this is Bloomberg, this is the fund. See you next week. Good luck. And amazing experience. Even more so because it was a relatively small fund with a very wide mandate. So basically, we had to take some guidelines relating to liquidity and size into account. We couldn't short, but for the rest, we could do everything, and that's what we did. So two young guys managing the fund, and the mandate, the strategy was actually pretty simple. We just wanted to find ideas, situations where the price was not reflective of our idea of value. And often you would find the biggest discrepancies in more complex, smaller situation, things were a little bit of hair on it, where stuff was wrong. And we did a lot of that, and it was incredibly learning for experience, because you had all the time to dive into these complex situations and figure out what would work and what would not work. We did that for about a decade, and it went very well, I have to say, up until ESG. So, and then ESG came, this sustainability trend, and the top brass decided that the fund had to get some more sustainable character. And I mean, nothing against sustainability per se, but if you just say, okay, I'm now sustainable and I invest sustainably, that doesn't work. I mean, it has to be way bigger than that. If you want to do good, you can do that. But it basically killed our edge, because we went from, suddenly in a week or so, we went from having a universe of thousands of stocks to a few hundred. And they were mostly larger, more covered stocks, and we didn't have an edge anymore. I mean, we became. I always said we adopted a negative alpha strategy. So it was time. I mean, we had a good track record. We didn't want to throw that away, so we decided to move on. And now we managed a few client-specific mandates. And it's pros and cons. And one of the big pros is we can do basically whatever we want, and we are very much on the research side as well. And then to the segue into the answer to your question is the putting out the writing and stuff, and the idea generation. So it's basically now I'm doing this 15 plus years. We have a network. I every day I get at least 10 ideas from other peers. I found this one. What do you think about it? Did you look at it? or maybe some others that are doing some work that found something interesting and just want to spar. I think that's, and obviously, X as well.
Yeah. So tough. How would you define your investable universe? Is there sort of market caps that you don't go over or under? I mean, it sounds like you do like to more or less hunt in the small micro space a little bit because you want to find stuff before other institutions have had a chance to cover it, or maybe have some more meaningful positions. So what does that universe look like?
Yeah. So I mean, in the old fund, we experienced it all. So we started relatively small, and obviously the focus was then on lots. I mean, your universe is way bigger, right? And one of the weird things in investing is that the more success that you have, the more difficult it becomes because your universe just goes down, maybe exponentially even. And we experienced that, right? But fortunately, a few of our clients just want to know everything. They just want to know, even the small companies that, even if they would bought out, a small company, it wouldn't matter to them. But they just, it's a way for them to keep tabs on the market and on trends, etc. So that's why we tend to look at everything. I mean, if you read the blog and see what I post about, what do you post about? It's generally a lot of event driven and maybe the smaller stuff. But I have to say that's just maybe a third of the entire portfolio. And the biggest part is the classic compounders company that you don't want to sell. Again, where the valuation does not reflect, the price does not reflect the valuation, but that we think in 5 to 10 years will do well. But to be honest, those are very boring stocks in a way. And the fun part remains, the smaller guys, the undiscovered guys, the more complex situations, and we just love to do that. I mean, it has been almost 20 years, and I'm still doing that. I'm still loving to love that.
100%. I mean, look, there's, once a small microcap investor, always a small microcap investor. I mean, at the end of the day, like, you're in it for the more, you want to make money, but it's so much more about the love of the game. I mean, I just had Brian Bears on the pod, and he's been extremely successful for 25, 30 years, and he to a T. Even he's saying that still, right?
Absolutely. I mean, it's a love that doesn't fade away in a certain sense.
I love it. So, just going through your Substack, I've been a subscriber now for a while. You also tend to look globally. So I'm assuming, anything and everywhere is part of this universe of investable companies for you guys. So what's some of your thesis on looking at companies even outside the US, North America?
Yeah. So, I mean, we have very much a European background, so that's why we looked at Europe, and we are very, very comfortable in looking at Europe. Obviously, there are many differences from a geographical point of view, and also in terms of the kind of stock exchanges, the quality of the stock exchanges, and the listed company. But I mean, in the end, it's all more or less the same. A good company is a good company. So we are very comfortable in Europe. And then obviously the US, which is in some way it's an easier market because it's way more coherent, consistent, and obviously it's just one big giant market, and with way more information. The quarterly reporting there it's normal. In Europe, generally, with the smaller you get, the less information you get, and it's normally it's once every 6 months you get something out of the company. And if they do it every quarter, then it's because they want to do it. But it's not the standard. Well, in the US, it's easier. And to be honest, from a timing perspective, just I'm based in Europe, so when it's investing in the US it's way easier. I think from a European perspective, just the timing is a big advantage because you wake up, you have all the time to see if a company just put something out after hours in the US. Or maybe even before hours, you have all the time to study that. And then I think the stock exchanges are open a few hours less, if I'm not mistaken. So that's even better. So that's why we look at the US and Europe. And to be honest, I mean, we are open to look everywhere, but it's just so big. So that's why we tend to remain focused on Europe and the US, but simply because that's more than enough for us. I mean, we always have
that's
more,
a lot.
way, it's a lot. And we always have way more ideas than capital. And, I tried something, maybe going to, Africa, India, the Middle East, but Japan. There are tons of places with very interesting opportunity, but every time we dive in those holes, it's like, man, it's better that we stop. Otherwise, we just we will not sleep anymore.
100%. I mean, look, that's Europe and North America. That's a lot, right?
Yeah,
I mean, even just
absolutely.
in North America or even just Europe is a lot on its own. So, I mean,
yeah.
The fact that you're taking on both as part of your investable universe of companies, yeah. Plenty of work ahead of you. So I want to jam on a few topics that you've publicly talked about. More recently, you've gone on a little bit of a cannabis. I don't want to say rant, because it's not like you're a ranter by any means, but on a cannabis rabbit hole. So love to hear your thoughts there. I mean, it's funny. I had a conversation literally just the other day about. Or I think, we did it on I did it on a podcast that's coming up that I put out with Fadi Diab, and we talked about cannabis versus some of the other things, psychedelics and all that kind of stuff, and the thesis around that. So love to hear your thoughts there. I know, go cannabis. Where's your head at?
So, I mean, just as a background, we actually not invested in anything cannabis related anymore, but it's a very interesting sector and we have followed it for a few years, and we actually ignored it for the past few years after looking at it for some time a few years ago. And we, after some time, recently we went back, we looked at the sector, we looked at some of the companies we had on our list and thought, man, I mean, this is really changing now, because, I mean, obviously there was a hype, right? So if you go back, I don't know, maybe 4 or 5 years ago, I don't know exactly. And again, I'm not a cannabis expert on the sector by any means, but it was clear something was happening, right? That there was an interest, that there was going to be a future, and capital markets, the way that they are, if there's demand growing somewhere, the supply, you will get a lot of supply on the financial product side. So a lot of companies listed very soon, raised a ton of money. Then obviously the regulation came in, didn't made life a little bit more. Maybe more difficult than many of the companies were expecting, perhaps. Obviously, ESG and sustainability was a very, very big part of it. So in the beginning, you could do everything, and then in terms of ESG, you couldn't do anything. So we were looking at these companies, let's say 4 or 5 years ago, and we saw them investing, a ton of money, and we had a few questions about supply and demand dynamics going forward. They thought, this is going to be a little bit more difficult than maybe what some of these companies were projecting. So we did our work. We said, it's just everybody's just going way too hard into the sector. And we think we were experiencing it ourselves, right? I mean, we didn't invest in these kinds of sector before, but we every day we could do less and less because of ESG and sustainability and all these restrictions before we left. So we thought, okay, let's leave it there. And recently I just found this old watch list of cannabis companies, and I looked at them and I thought, man, I mean, besides that the stock they doubled, tripled, and quadrupled over the past few years, but the fundamentals were great. One of these companies I wrote about was Grown Rogue, for example, and this was another example of a company where I thought, okay, this is going to have a little bit of a difficult future. But maybe in the future, but it's very promising in the long term. And I went back and man, these guys are just ramping up. They're in the phase of it's profitable, it's growing. They have a way of doing stuff, of doing it, and it's just now a matter of replicating it in different cities, in different geographies, in different states, and obviously in terms of regulation, it's now much easier. And they're getting, permits. They have more than enough ways in order to finance their growth. And just looking a few years out, you would say, man, if simply based on what they have right now, these guys could generate, 40 to 60 million dollar EBITDA in a few years, and put the same multiple on it that they have right now. Like they're trading on at 10x right now, and you have I think 3 to 5x in just a few years time, and that's assuming that the multiple won't stay the same. That these guys, you still, I think, if you go to the big brokers, you can't buy them. So there is also a discount on the multiple for the fact that you cannot buy them. It just makes it very, very interesting. And so another one I was actually looking at just right now is Good Shroom. The ticker is MUSH, MUSH. That's a MicroCap. I think the market cap is like 8. But these guys are profitable. I mean, it's the third quarter. I mean, where do you find? I mean, how often do you find a company which is a market cap of what is it, 8 million, no debt, a good balance sheet, cash flow positive, 3/4 of net earnings, positive net earnings, and growing top line more than 100%. I mean, come on. This is exactly the kind of stocks that you want to look at, and for all the same reasons, right? Because you know that the smaller you are, the less your multiple is because your multiple is also obviously a function of liquidity of the stocks, how many people can buy you, etc. And you want to get early on into this kind of company. So very interested in the sector. Again, we're still doing our work. We don't know anything in a certain sense, but we just like what we see, right? I mean, often you don't have to be the first one. I know that there are some people on X, I follow them, just experts in the field that have been, pounding the table for the past 4 or 5 years, and obviously did really well. But we just prefer to wait and see that things all align. And like now, for example, where it's just a matter of execution. And if you just stay where you are with the assets that you are, you can generate multiples of what you earn right now. And you just need a very simple low multiple, and you can have a multi-bagger. But let's look 2-3 years down the road. What if the growth remains so strong? No way it's going to be trading at high single-digit EV/EBITDA multiples or whatever multiple you want to put on it. It's going to be way higher, and obviously then you have all the the liquidity and momentum flywheel effects that you always have with micro and small caps. So yeah, man, I think it's a very interesting sector. I think we saw some multi-baggers over the past few years, but it's just the beginning. I mean, it's just the beginning.
For sure. I mean, what was it? Was it the fundamentals of? Oh, by the way, real quick, are you shareholders at all in Grown Rogue?
Yeah, sorry, no.
Or Mush?
Again, I mentioned it before. We are not invested in the sector, and
Okay.
we're just looking at those names, and we are not shareholders.
Very good. So, I mean, when you started to look at cannabis, were you drawn first, kind of analyzing the fundamentals of these couple companies, and then you're like, all right, well, let's look at the sector as a whole and figure out why it's so hated right now? Or did you kind of look at the sector and be like, wow, it's really hated right now, there might be value here?
Yeah, I mean, to be honest, the first time that we looked at it was years ago, was even before the entire hype, and we thought, again, with this sustainability slash ESG thing going on, hype. Now, thank God, now it's improving. But we thought, wow, this is the perfect sector. I mean, because if you look into, I think there was a period where a lot of data came out about the products, about all the different, health-related components, which were, very promising, and you could do a ton with the product, which, from a health perspective was good, which obviously is a good thing, right? But we thought, I mean, just the stigma of it's going to make capital and growth, and particularly regulation. The regulators look at this sector, and ESG, just hammer this sector. So we knew at some point, now a lot of capital is going in, but it's because it's insignificantly small. But when it will grow, we were 100% certain they will have some, sustainability, ESG slash regulatory slashback. And, it happened. And, as often, supply demand in the sector was a little bit off. But now, the sector was completely destroyed. And these companies, a lot of companies went bust or are still trading poorly. But there are plenty of companies that just, stay the course and are now finally reaping the benefits of a few years of difficulty. And this is, I think, the best moment to invest because the market is growing. Again, from the regulatory point of view, we have way more certainty and visibility right now. Most of these of the investors cannot buy these things. You have to open up a certain account in a certain region, and then you can finally buy it. So that's you have that going on for you, because I can guarantee you in 5 to 10 years time everybody will be able to buy these things. Maybe not everybody, but as the sector grows, it will be made easier. Again, it's a supply demand. If everybody wants it, the financial markets will make sure that you can get it, and it's incredibly cheap. So that's why we came back and we thought, okay, now is the time to look at this sector. But again, I mean, we're by all means any experts on it, but we're definitely doing our work right now.
Absolutely. So moving on to a couple other topics, because I mean, look, there's so much we could talk about here today, and we have limited time. So I wanted to get to one stock that you've been talking about both on your blog, is ADF Group, and this is one that quite a few guys I know in our space have been talking about. So what's your thesis here? You put out a post on Feb 1 about revisiting this. So love to hear your thesis and your thoughts on this company. Full disclosure, not a shareholder. Just
exactly. So ADF Group. I mean, this is why we are in microcaps right now, right? I mean, this is a company that has been listed for 20 plus years. I don't know, a long time. Obviously, very cyclical end markets. Stock went up and down with the markets. And a few years ago, roughly 2.5 years ago, we had a very, very tough market with decades of underinvestment in infrastructure. And by the way, I mean, just as a background, what does ADF do? So ADF, it's a small company based in Canada and the US, and they do big, complex engineering and steel installation products and systems. Think about very complex T structures made out of steel for whatever airport constructions, big buildings, etc. And like I was saying, 2-3 years ago, they started on this very, very big capex road on this automation. Sorry, let me just go back. They invested, I think it was 20 to 30 million into a new automation system to just not only become more efficient in terms of just lowering, hiring, increasing your gross margins, lowering your OPEX, but simply one of these things the issues that these industries have is that because these projects are so big, utilization rates went up and down. So once you have a big project, everybody's working on a project, but then the project was done, maybe it takes some time to start another project and utilization would go down as well. So that, and obviously your income, your earning stream was very, very volatile. And there was a lot of work that could be automated. It could be simplified, manual work that, a machine could do. And they started to invest in this automated automation platform, robotic automation platform, about 2-3 years ago. And they finished it recently. So they invested about 20 to 30 million. Just to give you an idea, back then, the asset base was 80 million. So it was a very, very big investment compared to the size of the company. And they completed this investment in Q1 of last year. And I mean, it was exactly what they were hoping for. At the same time, the end markets are coming back. So you have a few things going on. So after years of underinvestment, more and more investment is going into the infrastructure. You have several bills in the US that came out, the $1 trillion bills over the next, multi-year spending in big infrastructure projects that are coming up and that will, sustain the markets going forward. You also have some onshoring, so production coming back from outside the US and Canada to the US and Canada. So you have these two trends, and they inflected together with this company investing in automation and in efficiency, and now ramping up. And what we saw over the past few years, let me just put the numbers so you can have an idea. So you already saw earnings coming up, like 2021. So 2020, I think they had like 5 million EBITDA. That tripled in 2021. Then they started to invest in this automation platform, and in last year they did 25 million EBITDA. So it was 5x in 3 years, simply because of this automation platform. But the interesting is, so last year was a good year, and this year is going to be another good year as well, because on my estimates, they should be able to generate 50 million EBITDA, so double of last year, based on this, on the good markets, obviously, but also on the efficiency improvements. Because again, now, not only you have plenty of demand, but your utilization rate is now way higher, simply because you have this very, very big machine that takes over a lot of the work, more steady, so you don't have all these fluctuations, and obviously at way lower costs. And what we saw this year, Q1, Q2, and Q3, is that as this company was ramping up the use of this platform, this automation platform, earnings just continued to explode and to expand. And I think it was a few months ago, or maybe even 1 month ago, this company came out with an update on their order book, and they had like a massive order intake, like massive. I think the order book exploded to more than 500 million. I can't remember the last time this company had such a big order book. And that's how you go into this year, into 2000. It's 2025 for them, but it's the year ending January 2025. So just think about it. So from a market perspective, a few years ago, 2020, they were at 5 million EBITDA. Last year, it was 25 million, so in 3 years' time. This year, so ending January 2024, they will do at least 50 million, so double that, right? And they're going into this year with a record order book, and obviously this automation platform, which had a learning curve, so they learned a lot over the past 3 quarters, and now is ready to ramp, like full time, on this massive backlog. Obviously, we don't know anything about the pricing. They don't say anything about the pricing of these volumes, and that's a good thing. But generally, if markets are good, pricing goes up. So I simply made some back of the envelope calculations. So if we just take, the margin, so to speak, the marginal returns of what we had last year, over the year before, and you apply it on this growing backlog, this year should be another, massive year with 65 to 70 million EBITDA. That's like 50% growth year on year, based on what they are going to report in a few months. So, to make a long story short, this is a company where, it was listed for a long time, small, ignored, very cyclical end markets. Then suddenly the markets turn. They have this very big automation investments, and it's small, right? Nobody cares. So you had a few quarters where they started to say, guys, our order book is going up. Look at our earnings, it's going up. And nobody cared. And this company the shares were still trading at, say, between 1 and 2. And now, obviously, the shares exploded. I think it was a 5-bagger in 1 year. But from a valuation perspective, multiple perspective, not much expanded. It's one of those, cases where the earnings expand as rapidly and even more than the multiple. So it was trading at 5x like 3 years ago. It's still trading at 5x. There is some multiple expansion. And then the question is, okay, 2 things. 1, how does the future look? I mean, obviously, it's still cyclical end market here. So at some point, it will return. But everything points to at least 3-4 years of growth. Is 5x then a good multiple? I don't think so. It's way bigger now. Canadian industrials and other steel companies are trading at, say, 7 to 12 times. So why should these guys trade at 5 times? And then you have the second component. Then growth at some point, right, should come down. You cannot sustain 50% EBITDA year on year. And obviously the growth that we had right now was just from this automation platform. But at some point, it's a very working capital heavy industry. So they generated some cash, but not much, because a lot went into, ramping up production and just fulfilling all this demand. So when growth comes down, even if it's a top line between 5 and 15%, your cash flow generation will explode. So even if you say, from a conservative perspective, let's say they get to this 65 to 70 million EBITDA this year, so ending January 2025. That's 50% year-on-year growth. And let's say then the growth goes to zero. Your free cash flow generation will explode. And just simply based on their order book. So even if you say, okay, they will not grow for the next 2 years, on my estimate, these guys could easily generate 30 to 50% of the market cap in net cash. So just think about it. Again, 5 times EV/EBITDA, a massive, on continued growth ahead, visibility in the next 3, 4, 5 years. I mean, these are big infrastructure projects. They could go on for, the cycle could last another decade, but who knows? And cash flow generation will come up. No way 5 times, in my opinion, EV/EBITDA, it's the right multiple. It should be at least in the high single digits, if not the low teens, and still growing EBITDA. So you're talking about a company that could easily double from, over the next 2 years, from the level that they are at now.
Very good. All right. Well, thank you for sharing your full thesis on ADF Group. And just for compliance and full disclosure, are you currently a shareholder?
So not me directly, but one of the clients is. So yeah.
Very good.
So, sorry for the rant, Bobby.
No. There were 2 ideas. I had 2 ideas I wanted to ask you about. One of them being ADF Group. Due to just within our own microcap universe, it has come up on quite a few radars and been talked about in a few newsletters. And so I thought it would be cool to actually have, somebody come on and provide their thesis on it. But there was another one I wanted to ask you about that I think it's probably one of your more popular posts that you've had on ToffCap of late, and that was on DNO. So oil and gas production company that's listed on the Oslo Stock Exchange. So love to hear your thesis here.
Yeah. So indeed, DNO, Norwegian oil and gas company, this is one of those companies that I was referring to before. So preferably every investment that we make is like ADF, right? Good company, quality, etc., but small, undiscovered, and it will grow and the multiple will reflect it. But this DNO is, is one of those that I mentioned before, the hairy ones, right? That you look at it and you say, wow, it looks cheap, but definitely for a reason. And then if you dive in, you say, whoa, yuck. So this is a company that is around for a long, long time and always traded at, very, very cheap valuation relatively to many peers. And the reason for that is that a big part of the portfolio of the production assets are located in Kurdistan, which is a region in the northern part of Iraq, going to a little bit Turkey and Iran as well. And obviously, a region with, a history of, definitely some political volatility there. And this company, it has been successful there, and they generated cash there. It was volatile there. Every now and then something happened, but in 2019, this company decided to finally, let's accelerate our pivot away from Kurdistan. And they were also present in the North Sea, and they started to invest a lot in exploration into the North Sea, and has been very, very successful so far in its effort. With 2023 was a very pivotal year for them. They discovered about 100 million barrels in the North Sea. This exploration and discoveries will continue in the North Sea for the foreseeable future. I estimate between 15 and 20% of their 2024 projected production will come from the North Sea. That will just continue going forward. So you have two things going on. One is a company that has been, basically trading at a discount because of their assets in Kurdistan for quite some time, that is very quickly pivoting away from the North Sea in a very successful way. I mean, last year was just a massive year for them in terms of discoveries. Obviously, you still need a lot of capex, etc., going on, but that's the first sign. So I think that as the company pivots away, the valuation should reflect this higher quality portfolio. So that's one part of the thesis. But and by the way, I think just based on what they discovered and on their future production, being very conservative without going into the numbers on future production estimates in the North Sea, I think the current valuation makes up at least 75, if not more, percent of the current valuation of the company, the part from the North Sea. But what makes it now even more interesting is that there are like 5 or 6 big major oil companies in producing in Kurdistan, and the oils, it's obviously a very inland based production, and there's a pipeline that goes from Kurdistan via Turkey into basically the international oil markets. That's that pipeline has been shut down in March of last year, and because of an arbitration dispute between Iraq and Turkey, and that has been shut down since. And it's a little bit of a lose situation. So in terms of it, I mean, last year was very, very turbulent for them, because obviously this thing shut down and then you have to reroute away. It was, by the way, not the first time. Years ago it was also shut down, so they had a plan B in terms of things going on. But it's not that they production went down for a few quarters. Now then production slowly but steadily came back again. And now they're basically selling all the oil produced in Kurdistan locally. And by the way, locally does not mean that it's for local consumption. It's for local traders. And that oil still finds its way to everywhere. But instead of going through the pipeline, it goes via trucks. And the simple conclusion is that they're selling it at way cheaper than what they would do with pipeline. On the pipeline, I think the pricing was more than $60, and now it's low 30s. And obviously now, I mean, they're still making money from this. Why? Because the capex and investment have come down a lot. So even selling this oil in the low 30s, it's still very, very cash flow generating for them. I think they, at this point, from their Kurdistan assets, they generate about $120 million in free cash flow per year. So that's not bad for a company that is trading at, what is it, 700 million EV net cash. They have, I think, 150 million net cash on the balance sheet. So all in all, this is okay. But there are many signs that this pipeline might be reopening. So I think just this morning or even yesterday, I read that the Turkey President Erdogan will visit Iraq, and one of the top things they will be discussing is the reopening of the pipeline, basically. So, and we have, if you go back over the past few months, a lot has been, there was an increasing amount of information, of news coming out that, and the imminent reopening of the pipeline might be the case. So bottom line, here we have an asset, very cheap, which is moving away towards a more quality. The portfolio is moving away to a more quality kind of structure towards the North Sea, which is, in my opinion, not recognized. Still earning cash from its Kurdistan assets, with this optionality of the pipeline coming back and basically doubling the revenues from the Kurdistan, which again are half of their production assets, not into the price. So you're paying nothing for this optionality. And, it's one of these things where you say, okay, you know what? It can be volatile. A lot can happen. But, I'm looking at it and saying, worst case, nothing happens with the pipeline. And in 2 years' time, they continue to discover stuff and ramp up production in the North Sea. And that just, would change slowly but steadily the picture. Best case, next month, they just, swing open the pipeline and your EBITDA goes to, through the roof. And you're trading at, less than 1 time EV/EBITDA.
Beautiful. All right.
That's in a nutshell.
In a nutshell. And real quick, for compliance, are you currently a shareholder or any of your clients a shareholder of DNO?
Exactly, yeah. Not us, one of our clients is.
Very good. And so I'm going to, in the show notes, I'm going to put the links to both your articles, one on revisiting ADF Group thesis, as well as your DNO articles. So I invite everybody to go and check those out if you want to learn more about ToffCap's thoughts on both those ideas. So, we're running up on the time here. So, to kind of close this out here, moving forward for the rest of 2024, when you're thinking about the markets, you're thinking about various opportunities out there, what's getting you most excited about the rest of 2024?
Yeah. To be honest, like I said before, we continue to have more ideas than time, to be honest, and definitely more than ideas than capital. And I think, the mid-cap, small mid-cap space remains interesting, right? The more the Max 7 and NVIDIAs of this world, the more they moon, the less attention is given to these smaller guys. And that's why you have like companies, again, like, the Grown Rogue in the cannabis space, but also DNO, and I'm now, for example, I'm looking at DGL Group. I'm again not invested in this one, and also not my clients, but it's a distributor of specialty chemicals in Australia. And this is one of those companies that is having a bad time. The markets are bad, but fundamentally they're doing actually okay-ish, trading at mid-single digit EV to EBITDA, with EBITDA probably growing, to my estimates, more than 20% a year for the foreseeable future. And peers trading at low double-digit EV/EBITDA. Just think about it. These kinds of opportunities. If they just do what they did over the past few years, and you have a cyclical swing back, on 20% EBITDA CAGR at least for the next years, and a doubling of your multiples, you have a multi-bagger over the next 4 or 5 years. And these kind of opportunities continue to exist. They continue to be, increasingly more ignored. And just, Bobby, that's just the way how the market is. To give you an idea, right? When I started 15 years ago with the fund, we could do whatever we wanted. And one thing that we did is we invested, I think it was in Ubisoft, if I'm not mistaken. So they make these games, right? And back then, this company, it was the classic, okay, we're going from hardware to software sales, so downloading instead of going, to the physical thing, cutting out the middleman. You just had one AAA franchise, moving to more AAA franchises, in-game, whatever. A lot of things was going on. But every now and then, this company, would come out with a press release, we're going to postpone the release of this game to next quarter. And the stock would, go down 30% plus. And we would love these things, right? Because the long-term story was intact, but it would just go down 30%. Nobody cared. We invested in that. Every 2-3 quarters, stock corrected 30%. Nobody cared. Nobody gave us a call. And, they said, did you buy more? Yes, of course. Fast forward, almost a decade after that, days where the stock would correct like 2-3%, we would get calls from, risk and compliance saying, what is happening with the stock? Why is it down like 3-4%? And this is maybe this is one of maybe the most a little bit exaggerated story. it's not the case for everyone, but for a lot of my peers, that's the case. So that's why this small and micro cap space, it's smaller, it's underfollowed. I think it will continue to be more underfollowed as we go forward. But that's where I think increasingly more opportunities will be for the foreseeable future. So I'm very, very bullish about this segment. Again, in 10 years, 20 years time, you will still, have me on a call discussing about some weird PICO or microcap.
Well, I hope we don't have to wait 10, 20 years for you to come back on the pod to share some more of your ideas. So I think that's a great place to end it. ToffCap, where can our audience go and subscribe to your newsletter as well as follow you on Twitter X?
Yeah, sure.
ToffCap.
Yeah.
I've been saying it 1,000 times.
Exactly. It's very easy. It's at ToffCap, TOFFCAP. And the blog is ToffCap at substack.com. We publish very regularly new ideas. What we also do is every 2 weeks, we publish our Monday Monitor, which is just a ton of event-driven ideas. And I think, to be honest, we prefer that product to just, the stock pitches, because, with the stock pitches, it's not, it also has to reflect, your way of investing. So it may be interesting for me, but not for you so much. But this event-driven monitor that we have is just every 2 weeks we come out with very interesting event-driven stuff that caught our ideas, and think about spins, acquisitions where you get a contingent value right, which is not valued into there. Some weird big buybacks of companies that screen very cheaply, where we say something is going on here, and these are just short list of bullets. And to be honest, that's actually the product that we are most happy to be about. It's all free. We just put it out there. We don't care. That's it.
Beautiful. Well, ToffCap, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
Thanks, Bobby.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.